Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hey, thank you, Jim.
Danielle, the coronavirus, of course, the talk of the planet. People are worried about how the financial world might deal with this, and can the financial world deal with the shock of this virus and what it might do to business?
Well, it's interesting because, I've been following quite closely the medical community, and their take being that, the world is much more prepared, certainly in North America, for this particular outbreak than they were for the SARS outbreak in 2003. And I think, that sounds reassuring, and I'm glad to hear that they feel they're more prepared. Time will tell. Of course, we've still got very few cases of it over in this part of the world. But we're certain to see a spread more. I think that they probably are more equipped, and that would be great if we could, slow the spread of it or have it not be as bad as it threatens to be. The problem I see is that from a financial perspective, of course, we are much less prepared today than we would have been in 2002-03. And the reason is just entirely to do with the debt cycle. If you look at what was happening in 2000, we had the big, fall in global markets, the recession, which was relatively mild. But at that point, when the SARS outbreak started in 2002, global markets had already, stocks had already fallen 50 to 80%. Weak players had already gone bankrupt. Criminals had already been, rounded up. We were really we'd already been through a major cathartic cleaning phase, that had taken a lot of the froth and waste and nonsense out and left really the strongest players. If you also think about it too, we had a fraction of the debt level that we have, certainly in households, certainly in Canada, we had, nothing like what we have today. Today we're much more indebted. Corporations are much more indebted today. The amount of junk debt in the world is mind-boggling, far above the subprime peak in 2007. So really what that means is that, add to that the fact that all the major governments of the world have now, much more debt to GDP. Most countries have a debt to GDP ratio above 90%, which means that they're already, having to add debt basically just to service the debt they have and to keep necessary services running. So because of that, any kind of a decline or shock that comes to one's income stream, for example, is very difficult to absorb. Any lost time on the job, any lost revenues for companies, all of that, lost GDP for economies, then lost tax revenue for governments. All these knock-on effects are very difficult to absorb when you have already slow growth, which we've had in the last couple of years in the world. We've been, GDP was slowing into the end of 2019. That was well before the SARS stuff hit. Let's keep in mind that this has only been in really the month of January that we've really started to see the pickup of this story internationally. And the manufacturing data, for example, in America was falling all the way into the end of December. It's been in contraction mode for 5 straight months. And that, again, before this, German factory orders, another major economy in the world, it was negative 8.7 year over year into the end of December, again, well before the impact of this. And now we have, China being 17% or so of the world's GDP today versus something like 4% in 2003 when the SARS virus broke out. So again, we already had the slowest growth in decades in China in 2019, barely 6%. And so now we've got 2/3 of that economy closed down and something like 80% of their manufacturing is closed. And that's sort of indefinitely. We're not sure how long that is going to be the case. So we're for sure going to have a hit to global GDP in 2020. And as I say, people like the organizations like the IMF had already ratcheted down global growth expectations for 2020 well before this news hit. So even I noticed Foxconn, where Apple makes its iPhone, was turned down or was closed is currently closed. And so, Hyundai, fifth largest global automaker in the world, they are completely closed in Korea right now because they have a lack of parts. There's news of European auto factories having to be closed because they're starting to have too little parts. So you can see the knock-on effects here are far beyond just China. And of course, China itself has the highest debt levels ever, actually, of any country ever in history. I mean, we don't even know the debt on debt there is just lunatic. So this all makes for a very fragile backdrop. So it's not that I think the coronavirus is necessarily going to be, the Spanish flu here or anything, but the point is that it wouldn't need to be to have a very negative impact on a fragile backdrop. And, the other thing is that the stock market's response in the last few months has been this parabolic move again. Why? Because the economic growth has been weak, because there's been a lot of disruption in the overnight lending markets between institutions, bank to bank. Hedge funds have been short on cash, and so the central banks have stepped in to pump liquidity into the banking system, ostensibly to calm things down, but really as a bailout of sorts to these highly levered speculative firms. So when you think about that, making assets even higher in this environment just really makes things that much more fragile. Another really good example is, we're seeing a rebound in home prices, certainly in Toronto and in some other parts of the world. And people are saying, even in America, prices have gone higher as rates have come lower. So here you have this conundrum again of the global growth is slowing. That was happening, as I say, before the coronavirus. We have injections of liquidity because there's stress in overnight lending markets, all signs of negative factors that are not positive stories. But because you get these injections of capital by central banks, you end up with inflating asset prices, inflating housing prices. That just makes things that much unaffordable, which were already, really stressing the average household to just try and keep a shelter over their heads. And so we're really counterproductive. Easy money has really made things a whole lot worse. As I was writing on the blog, easy money has really set us up for much less resilience in the face of these risks.
We'll have more with Danielle Park right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, do the central banks have the tools, as they like to say, to deal with any kind of financial crisis that could be created by the coronavirus?
No. You see, this is it in a nutshell. So even they have been admitting for some time that they have really, blown the budget, so to speak. There's really, in just trying to keep the slow growth recovery accelerating or moving forward or continuing for the last many years. And let's not forget, they've succeeded in making this the longest so-called technical recovery of the post-war period. So they've elongated this cycle significantly. The problem is that they were exerting all their emergency measures and injections and rate cuts in the so-called recovery part of the cycle. So now we get to this, as I say, life is full of risk. There's always going to be shocks like this, whether it's, a debt blow up somewhere in some part of the economy, like the BBB sector, for example, corporations with the most debt ever and the most junk debt ever. That's a potential blow up zone that could be a major shock. Then you have something like this, as I say, a virus, which can be a major shock to the world economy, as this one is. And what happens is that then everyone's sort of addicted to the idea that the central banks have got this all under control. And they themselves have been coming out warning, listen, we don't have much left here to offer you. I mean, the latest speech to that effect was by the new ECB chief, Christine Lagarde, who was speaking in the European Parliament this morning. And she's saying, this low interest rate environment has significantly reduced the scope of the ECB and other central banks worldwide to offer ease in the face of an economic downturn, which is exactly what we're facing right now. And so, just as the central banks are looking to governments and saying, hey guys, you need to step up the spending. We need fiscal measures here to try and offset the weakness that we're seeing all around the world. But of course, there's a lot of gridlock in governments because there's so much extreme financial situation going on in the population all over the place. You've got a lot of polarization happening in governments, and they're not able to meet in the middle much or come up with constructive, widely accepted plans in terms of fiscal measures. And so, you had the Trump tax cut, which was rolled out in 2016. The stock market went wild. We know now, and everyone was, I was saying this at the time, there was no bind in terms of global investment productivity that was needed in terms of, in other words, there was overcapacity in the system already thanks to years of easy money and abuse of debt. There was excess capacity, so there was no real business case in those established business models to expand operations further. And so, in fact, companies didn't expand operations, so they didn't reinvest in business investment. They didn't hire more people and all that to any significant effect. They just bought back their own shares and did a bunch of gimmicks which boosted their earnings on a short-term window but didn't do anything for longer-term productivity. And in fact, in Canada, we've had that problem in spades because Canada's, per capita GDP has actually been in decline now for a few years. And you had our Bank of Canada deputy yesterday talking about that and saying, hopefully with immigration or something we can somehow get our productivity per capita up in Canada. But, they're looking at Japan as this long-term example where central banks have been at these tricks for 30 years now. And they have had a very stagnant economy, and they haven't had, the full recovery in asset prices that they, a fraction of what they were at the peak of their bubbles. So it's a very dangerous time because governments are looking to central banks and saying, hopefully you guys can do some more magic tricks. Central banks are saying, we're out of tricks. We've literally run out of runway here, guys. We're looking to you to figure this out. But as I say, a decade of easy money means governments are really cash strapped. And this is, very vulnerable because so much of the revenue has been coming from things like overinflated housing, from, sectors that are not sustainable, on a long-term basis in this environment, which can't keep, going up forever kind of thing. So you've got it's a really, a catch-22 classic. Australia's Prime Minister was saying just, today as well, noting that they've had similar headwinds to Canada, right? The downturn in commodities and, oil, as well as the fall off in Chinese demand with, even in the slowing growth cycle in the last few years there, but also now in spades with the shutdown of 2/3 of the Chinese economy right now, basically offline. So they're having a major impact in Australia, and he's saying this is going to be very significant to our gross domestic product in 2020. And, again, at this point, no one can quite see how long this situation will continue.
We'll have more with Danielle Park right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF.
surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, for people who are interested in alternative energy, what's happened in Alberta?
Oh, so Alberta, there's been an announcement. They're building out the largest solar farm in Canada, 5,000 acres in southern Alberta. It's to power some 100,000 homes. It's all privately funded, private investment, no subsidies whatsoever from government. The point is, it's in process now. They're hoping to start building it this summer. And the point of the companies that are doing the work is to say, listen, solar power is now competitive without subsidies. So building new power systems and storage is now price competitive with traditional fuels, and actually, is going to bring a lot of new jobs to the area. So it's a very positive story, and it's an example of, when we look at what can governments do here, what can business do here to try and offset the negative effects of this aging, indebted population, the slump in consumption globally, that inevitably has to happen, because after the debt rush, as I like to say, we cannot keep adding, 100 and 200 and 300 times more debt for, much longer here. We've really hit the end of that idea. And so you have to look at other ways. How can we, as Deputy Governor Wilkins was saying yesterday from the Bank of Canada, how can we increase the productivity per capita? So I go back to how we have to figure out ways to not just make things more expensive so people have to borrow more just to try and make ends meet, but how can we make the cost structure less expensive, more efficient? And so one of the ways to do that, of course, is through infrastructure investment. And that doesn't mean the old staples, the oil and gas staples that we have relied on so much in this country and in other places. It means many of the new forms of energy and storage, which are gaining popularity all over the world. I mean, every other day, someone's announcing the next biggest rollout of one of these types of new renewable energy programs. So it is definitely the right idea. It's a question of that perfect mix of how do we fund it. And the answer is, there's got to be some focus on policy incentives to change behavior for sure. And many studies have come out saying it's really important that we get policy behind new forms of technology and energy, which will help us improve productivity, efficiency, and make new jobs. So, carbon neutral, zero waste circular systems is a whole new business model where, so for example, one of the world's biggest offshore wind developers is a company called Ørsted from Denmark, and they just came out with an announcement this week that they're going to take steps to become completely carbon neutral in their operations over the next 5 years, and that includes their suppliers. So there's been a lot of people rightly pointing out that you can't just, make electric cars and plug them into a carbon intense electric grid, because that doesn't reduce the fact that you're powering it from a carbon intense fuel. But what the whole point is to think in systems, right? So systems have electric cars plugging into renewable energy powered grids. And then, for example, this maker of offshore wind and offshore wind projects, which is a huge part of the energy puzzle in the world, and many countries are rolling them out. But the reality is, again, that they're pretty carbon intensive in how they're producing these, whether they're solar panels or wind turbines. And, you have to look at the entire system and figure out how to make the whole thing clean and sustainable. And so that's end to end. That includes in production, in fuel, in end of life. How do you recycle or reuse or, break down the parts at the end. So this is really the new model, and it's very exciting because many businesses are seeing this and saying, okay, and so Vestas, for example, which is a turbine manufacturer in Denmark, they're saying, fine, we're gonna take up the pledge. We're going to figure out how to be completely carbon neutral, have all of our energy that we're using in creating these things come from renewable sources. We're also going to have work towards this circular idea of having no waste, whether it's in our packaging, whether it's in our reuse of our materials at the end of their life. So I'm not saying it's not a huge challenge. Of course it is, but it's a massive puzzle. And, you've got also insurance companies saying it's essential that we do this because there's risk in the world that is only getting worse, and we're not going to be able to fund it or to cover it, or it's going to be unaffordable if you guys don't start taking serious action to shift behavior. So that was another story I was writing about this week because the head of Intact, which is Canada's largest provider of property and casualty insurance, we've had a massive increase in reported insured losses in Canada over the last decade. They've quadrupled in Canada. The amount that this is for catastrophic events, storms and floods and fires and things of that nature, which are all directly related to the change in the climate. So the insurers are saying, hey guys, we're going to have to increase premiums and deductibles and things to cover this, because, we're a for-profit business. We're not going to be able to continue to have quadrupling of our payouts if we're not getting the funds somewhere else. And also, with investment yields having come down, back to the central banks, the suppressing of rates, the forcing assets to, ridiculous highs, what's happened is investment yields have compressed so much, interest rates have come down so much to reflect the slow growth environment that insurance companies are getting squeezed, not just on the payout side, which is going up so much, but on what they can earn on the funds that they have to match to their liabilities. And so this is a huge story in the world. Very much in the last 50 years, we've all become very sort of complacent with the idea that we have insurance for things, right? That you don't have to have property risk because you can buy coverage for that. But what if we're in an environment where it becomes increasingly unaffordable to provide coverage, or in many cases you just can't get coverage? This is the reality of these high risk areas where insurers are just saying, we can't even justify offering coverage in that place anymore. And so what this does is it really makes a very difficult thing. It's a total different paradigm shift. So I'd suggest to you that we're coming into this time where no longer will central banks be able to impact and support and rescue in the way that people have come to expect or think that they can. At the same time, governments have finite, resources to offer, and insurance companies are saying, we're not paying out to the way we were, becoming a lot more careful, a lot more risk assessment in terms of the changing facts at hand. And so it really goes back to more personal responsibility on individuals, and they're not prepared for this because they have the lowest savings rates, the most debt, so we're in a whole transformation here, back to more personal accountability, more personal funding, away from debt, away from magic tricks, and more to actual things that will improve the quality of our life, make us more efficient and more productive. So I think it's going to be a really amazing decade. From here to the 2030s is going to be mind-boggling, the shifts at hand, but it's just that most people are not prepared, and in many cases they're not even thinking enough about the big picture here.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.